You might have heard of crypto scams, investment scams, or even know someone who's been a victim of cybercrime. In fact, someone in my own family fell victim to it. To understand how these scams really work, I dug deep through a report by the United Nations Office on Drugs and Crime. And what I found was both fascinating and scary, revealing just how big a threat this is to our society. That's exactly what I'll cover in our first story. But cybercrime isn't the only challenge we're facing. There are some major risks threatening the global economy right now. To better understand these risks, I went through the Global Financial Stability Report, or GFSR, which explains how the global financial system functions. And so, in our second story, I'll share the most interesting and impactful insights from this report. Welcome to the fourth episode of our newest show, The World Simplified. I'm Tharun, and every week on this show, I simplify some of the biggest developments in finance and economics that are reshaping our world. I'm going to start by talking about something that sounds like a cyber thriller, but it's very real. Around the world, new organized crime groups are becoming more powerful. They're smart, tech savvy, and ruthless. Let me begin by answering a simple question. What is transnational organized crime? It's basically crime that crosses borders. These criminal groups are not just in one place, they operate across multiple countries. But why should you care about this? Because these crimes directly affect our daily lives, from our money to our safety. When you hear about people losing all their savings in an online scam or cryptocurrency being stolen, it's these groups behind it. In the last 5 years alone, these groups have grown quickly, earning up to $37 billion in 2023. Just think, $37 billion, as big as some of the world's biggest companies. These criminals operate like businesses, but instead of selling products, they sell lies, scamming innocent people on a large scale. This is happening globally, and the effects are terrible for people who lose not only their money, but also their sense of safety. These scams have become a mega nuisance globally, and the scale and scope is mind-boggling. Now, here's something even more surprising. These crime groups are very professional. They have offices, HR teams, and even training programs for their workers. They give rewards and set goals for their workers. These groups have become so efficient that stopping them is almost impossible. In Myanmar, Cambodia, and Laos, there are places like KK Park that look like tech parks but are actually heavily guarded compounds. People are promised real jobs but are instead forced to scam others online under harsh conditions. These places are controlled by powerful people and rented to different criminal groups, each running its own illegal operation, like online gambling or cyber fraud. Criminal groups have started using advanced ways to recruit people, like posting well-written job ads on LinkedIn, offering exciting jobs in Southeast Asia. Victims end up trapped in these compounds, forced to scam people under extremely harsh conditions. This shows how these groups have become more professional and efficient, and why you need to understand them better. Now, let's look at the different types of scams these professional groups are carrying out. I'll talk about three common scams: pig butchering, investment scams, and job scams. First, the pig butchering scam. One of the biggest scams making news is called pig butchering. It doesn't mean what it sounds like, but it's just as dangerous. Scammers spend months gaining the victim's trust and then introduce an investment opportunity that seems too good to be true. Before you realize it, all your savings are gone. Let me give you a real life example. A young professional in Singapore met someone on a dating app. They got along well, and over a few months, this new friend introduced them to an investment opportunity that looked great. It seemed real, with proper websites, fake testimonials, and even fake customer service. He invested over $100,000, or 83 lakh rupees, of his hard-earned savings, but it turned out to be fake. The scammers disappeared and all the money was gone. The victim believed they were building a genuine relationship, which made the betrayal even more painful. Second, investment scams. Investment scams often promise high returns with little or no risk, taking advantage of people's wish for financial security. These scams look like real investment opportunities, often in stocks, cryptocurrency, forex, or real estate. For example, scammers have posed as representatives from well-known investment firms using fake websites and professional-looking documentations to convince people to invest. One case involved scammers impersonating a reputable investment company and promising guaranteed returns through a cryptocurrency platform. And similar to the previous example, they provided victims with a professional website, fake client testimonials, and even call center support to build trust. Victims watched fake dashboards showing rising profits, prompting them to invest even more. Eventually, the scammers vanished, leaving the victims with significant financial losses. Third, job scams. Job scams are very dangerous because they take advantage of people's hopes and dreams. Scammers post fake job ads on real websites promising high paying jobs in other countries. Victims often travel to Southeast Asia and find themselves trapped in locked compounds. Their passports are taken away and they are forced to work. For example, a young man from India was promised a good IT job in Cambodia. When he arrived, his passport was taken away and he had to work 14 hours a day scamming other people online. He described the condition as unbearable, sleeping in crowded rooms, limited food, and constant threats from armed guards. He managed to escape, but many others are not so lucky. Sometimes the scammers ask for ransom from the families of those who are trapped, making things even worse. Families often have to sell their property or take loans to get their loved ones back, but these criminals usually do not plan to let them go. Now let's talk about how money laundering fits into all of this. This is where things get even more complex. Criminal groups use something called underground banking to move money without using regular banks. It's fast, efficient, and very hard to trace. Casinos, especially in places without strict rules, are popular spots for these criminals to clean their money. They also use cryptocurrencies and unauthorized virtual asset services, which help them move billions of dollars without getting caught. Criminals use junket operators in casinos to launder money by moving large amounts of cash without getting noticed, making it look clean through the casino's records. This happens in places like the Philippines, Cambodia, and Macau, making it a big challenge for law enforcement. Another example is the use of cryptocurrency mixers, services that mix users' different cryptocurrencies and make it nearly impossible to trace transactions. Criminals use these mixers to launder millions of dollars, and because cryptocurrency works outside regular banks, it's very hard for authorities to follow the money trail. Cryptocurrencies have become a major tool for these crime groups, allowing them to move money anonymously. They also use fake cryptocurrency exchanges to move and hide their money, making it hard for regulators to find out where the money is coming from. But why does all of this matter to you? Because these scams don't just affect the victims, they hurt entire economies. Criminals use dirty money to buy property, which makes housing prices go up and makes it harder for regular families to afford a home. These scams create real problems in our everyday lives. Now, there's something called crime as a service that is as important to understand. It means organized crime is working like a business. Imagine being able to hire a hacker, someone to launder money, or even someone to run a scam, just like hiring a freelancer for a job. These crime groups have made a market for crime. Specialists offer services like hacking or laundering money, all for a price. This makes it easier for even a small criminal to act like a big crime organization. They can just rent the skills they need instead of building everything themselves. For example, underground data markets sell stolen credit card information, malware, and hacking services for a price. Bulletproof hosting services give these criminals the tools they need to carry out cyber attacks while staying hidden from the authorities. These services have made it easier for cybercriminals to get started and specialize in different types of crimes, making their operations more effective and easier to grow. The ability to outsource different parts of a crime helps criminal organizations grow and adapt quickly. This makes them very hard for law enforcement to deal with. Imagine fighting a network that is always changing and always has the latest tools and skills, no matter where they are. That's the real strength of crime as a service. And if you think these crime groups are old-fashioned, think again. They are using new technologies faster than anyone could imagine, often faster than the police. They use generative AI, deepfakes, blockchain, and more to get an edge. These are not just fancy terms, they are now important tools for these crime groups. Deepfake crimes are becoming more common. Criminals use AI to create fake identities that look real. Imagine getting a video call from someone who looks and sounds like your friend, but it's actually a deepfake designed to scam you. These deepfake scams are becoming a regular tactic for crime groups.
For instance, in Japan, a businessman lost over $200,000 or 1.6 crore rupees after getting a deepfake video call from someone who looked and sounded like his business partner. The fake partner said they urgently needed money for a new deal. The businessman sent the money only to find out later that his real partner knew nothing about it. These deepfake scams are becoming more common and are now a regular tactic used by these crime groups. Another worrying example is when deepfake technology is used to pretend to be CEOs. Imagine being an employee who gets a call from your boss telling you to transfer money to a new supplier right away. Everything seems real, the voice, the urgency, but it's actually a deepfake. This has happened, and criminals are getting better at using these tools to take advantage of trust. By the way, to demonstrate how real deepfakes can be, this entire section on deepfake crimes is a deepfake video of me.
Generative AI tools are also being used to create phishing emails, scripts, and fake identities that make scams much more convincing. These AI-made profiles are used on social media to gain the victim's trust over time. Criminals can now create fake profiles with detailed backstories, photos, and activity, making it very hard for people to tell the difference between scam and a real person. The use of blockchain and cryptocurrencies has changed how criminal groups move money. Blockchain allows them to transfer money globally in a way that keeps their identity mostly hidden. With the help of unauthorized virtual asset services, these groups can launder millions of dollars without much risk of getting caught. Cryptocurrency mixers make it even harder to trace transactions, making it almost impossible for law enforcement to track the flow of money. But why does all of this matter to you? Because technology isn't just helping regular people, it's also making things easier for criminals. These tools help criminals work better and stay ahead of the police. The more advanced these tools get, the more everyone is at risk, from individuals to big companies. And then there's the darkest part of all this: human trafficking and forced labor. This might be the most shocking part of today's story. These crime groups don't just scam people, they also traffic them. Thousands of people from countries like China, India, and Malaysia have been tricked into scam compounds with false promises. They are made to work in online fraud with harsh punishments if they refuse. Around 2 lakh people from at least 60 countries have been trafficked into these compounds in the last 5 years. Imagine being promised a good job, packing your bags, and flying to another country, only to end up trapped in a locked place with no way out. You are forced to scam innocent people every day. If you refuse, you are beaten. If you try to escape, you are punished. It's a terrible situation, but it is happening right now all over the world. Similar to the Indian story that I spoke about earlier, another story involves a group of women from the Philippines who were tricked into going to Myanmar with promises of high-paying jobs in customer service. When they arrived, they were taken to a heavily guarded compound and forced to work in online fraud. They were told that if they didn't obey, their families back home would be harmed. It's hard to imagine the fear and desperation they must have felt, but this is the reality for thousands of people caught in these scams. So, what does this mean for all of us? These cybercrime groups aren't going away soon. They are becoming more advanced, more professional, and more dangerous. But knowledge is power. Understanding how they work and how to protect yourself is a first step. So, what does this mean for all of us? These cybercrime groups aren't going away soon. They are becoming more advanced, more professional, and more dangerous. But knowledge is power. Understanding how they work and how to protect yourself is the first step in fighting back. Whether it's knowing the signs of a scam, being careful about job offers that seem too good to be true, or just understanding the size of these operations, we can all play our part. Now, cybercrime isn't the only threat we are facing. Let's zoom out a little and talk about some of the biggest risks threatening the global economy today and why they matter to you. The Global Financial Stability Report is a report published twice a year by the International Monetary Fund or IMF to check how stable the world's financial markets are. Most reports by international agencies are usually boring, but this one is different. If you want to understand how the global financial system works in detail, this report is worth reading. It's a detailed read spanning hundreds of pages, but don't worry. I've gone through it so you don't have to. It's a detailed read spanning hundreds of pages, but don't worry. I've gone through it so you don't have to. What I found interesting were the different risks that the IMF is worried about. Talking about risks, it reminds me of a quote by Morgan Housel. The biggest risk is always what no one sees coming. But I think it's also important to pay attention to the obvious risks. So, first, let me start with sovereign debt risk. What is sovereign debt and why does it matter to you? Sovereign debt is the money that countries borrow to pay for things like healthcare, education, and infrastructure. It's like a credit card for the government. They use it to pay for things now and promise to pay it back later. But problems come when the debt becomes too big, making it harder to pay back. It's like if you maxed out your credit card and struggle to pay even the minimum amount, countries can face the same kinds of problem. There is a big difference between rich countries and poor countries when it comes to handling debt. Rich countries like the US or Japan borrow in their own currencies so they can print more money if needed. For example, Japan has debt that's more than 260% of its yearly economic output, that is GDP, but since they borrow in yen, which is their own currency, they have ways to manage it. The US, with a debt of over $32 trillion, can borrow money at low interest rates because the US dollar is trusted worldwide. Emerging countries like Argentina or Ghana don't have that advantage. They usually need to borrow in US dollars because investors don't trust their local currencies. Argentina's debt is about 90% of what its economy produces in a year, and they couldn't pay back their debt again in 2024. This was the ninth time they failed to pay. Ghana's debt is around 80% of its economy, and higher interest rates make it even harder for them to keep up with the payments. The real problem for these countries is that when the US interest rates go up, it gets more expensive for them to pay back their loans in US dollars. Imagine if the interest rate on your credit card doubled suddenly. It would be much harder to pay your monthly bill. This is what many of these countries are facing, and it means that they have less money for important things like schools, hospitals, and other services. Smaller economies like Zambia, Sri Lanka, and Ghana are also dealing with high borrowing costs. In 2024 alone, about $4 billion in debt needs to be paid, with another $13 billion in 2025 and $14 billion in 2026. About 60% of this debt is from countries that have to pay high interest rates of 10% or more. High US interest rates mean these countries have to pay even more to borrow, which creates a difficult cycle where they have to raise taxes, cut spending, or borrow more just to survive. According to the IMF, about 60% of low-income countries are either already struggling to pay their debts or are at high risk of getting there soon. Additionally, over 20 countries are in the process of defaulting or restructuring their debts, which shows how widespread the sovereign debt challenge is. This is a big deal because it affects everyday people. Governments end up having to cut spending on things that matter to citizens because they need to pay back their loans. Schools close, healthcare becomes inaccessible, and basic infrastructure projects are put on hold. Austerity measures or spending cuts often lead to protests and unrest because people are the ones who suffer from these outbacks. In recent years, we have seen the effects of debt crisis directly. In Sri Lanka, there were massive protests in 2022 because the government struggled to pay back its debt, leading to severe shortages of fuel, medicine, and food. This shows how quickly a debt problem can turn into a crisis affecting people's basic needs. Next, let's talk about corporate debt. That's the money companies borrow. Just like countries, companies borrow money to grow their business, like building new factories, hiring more workers, or creating new products. But right now, corporate debt is at a record high, around $88 trillion worldwide. In the US alone, companies have nearly $12 trillion in debt, and interest rates on that debt have doubled compared to a few years ago. This means that companies that borrowed a lot when interest rates were low are now struggling to make the higher payments. For some companies, especially those with poor credit ratings, often called junk bonds, are not able to pay back their loans. This means almost 5 out of every 100 companies in this category can't pay back their loans. Companies in emerging markets are in an especially tough situation. They borrowed money when interest rates were low, but now that the rates have gone up, their interest costs have increased significantly. The leverage interest coverage ratio, which shows how easily a company can pay its interest, has dropped from about 6 times the interest payment in 2020 to just 3.5 times in 2024 for risky companies. This means many companies are struggling to make enough money to cover their interest costs. The average refinancing rate for these companies is now 5.5%, much higher than the older rate of 3.5% on their existing debt. This puts a lot of pressure on companies, especially those in emerging markets that borrowed money at low fixed rates before interest rates went up. Now, refinancing costs are still high and companies are struggling to renew their loans without paying much higher costs. In sectors like retail and technology, this has become a big problem. Retailers that borrowed money to survive during the pandemic are now facing higher interest payments just when customers are spending less. Similarly, tech companies, especially smaller ones without steady income, are struggling as venture capital dries up and paying back loans become harder. In Europe, companies are also facing higher borrowing costs. The energy crisis caused by the war in Ukraine is making it even worse, especially for industries like chemicals and manufacturing. The default rate for European companies is about 3.5%, but some sectors like car manufacturing and heavy industries are under even more pressure due to the higher cost and supply chain issues. This is important because when companies can't pay their debts, they may have to fire workers, stop new projects, or even shut down. This slows down the economy and affects jobs and spending. For example, if a big company in a small town goes bankrupt, it can be terrible for that community. People lose jobs, local businesses lose customers, and life becomes much harder for everyone. Let's talk about commercial real estate, like office buildings, shopping centers, and other business properties. During the pandemic, the way we work changed entirely. Many companies realized they didn't need as much office space because more people were working from home. Because of this, the demand for office space went down. And in cities like New York and San Francisco, office vacancy rates are only between 20 to 30%. It's not just office buildings. Shopping centers are also struggling. More people are shopping online, so many malls are having trouble keeping their shops open, and some are being used for other purposes or completely abandoned. The value of retail properties has also dropped by about 15% since 2020. The main worry is that a lot of the loans for these properties are held by smaller regional banks. In the US, these smaller banks hold about 70% of all commercial real estate loans. If property values keep falling and landlords can't pay back their loans, these banks could lose a lot of money. This would make it harder for them to give the loans to small businesses and people, which would slow down the local economy. For example, if property values drop by 10%, it could lead to a 15% decrease in how much these banks can lend. This means there will be less money for businesses wanting to grow or people wanting to buy homes. US commercial real estate prices have dropped by 12% compared to last year, with office sector seeing a big 23% decline. Nearly $1 trillion in loans for commercial real estate will be due between 2024 and 2025, and there is a funding gap of $300 billion. The number of office property loans that are overdue has gone above 8%, up by 3% from last year, showing more stress in the market. This drop in property values is especially hard for smaller regional banks, which do not have as many resources as big national banks. If these smaller regional banks face big losses, they might not survive without the help from the government or by merging with other banks. This could affect the communities they serve not just by reducing loans, but also by impacting jobs and local investments. In 2008, falling property values led to many banks failing and caused a credit crisis, something regulators want to avoid happening again. You may have not heard of non-bank financial intermediaries or NBFIs, but they play a huge role in today's financial system. NBFIs include hedge funds, private equity firms, and insurance companies. Unlike traditional banks, these institutions aren't as heavily regulated, which means they have more flexibility but also more risk. Since the 2008 financial crisis, NBFIs have grown a lot, and now they manage over $240 trillion in assets globally. The reason they've grown so much is that after the 2008 crisis, regular banks faced stricter rules and couldn't take on much risk. NBFIs stepped in to fill the gap. While NBFIs can help spread financial risk and provide funding, they also bring new risks. The problem with NBFIs is that they operate in the shadows, often called the shadow banking system. When they face trouble, it surprises everyone, and the problem spread quickly. Because there is not enough supervision, risks can go without anyone noticing until it's too late. If NBFIs keep growing without control, the next financial crisis could easily start from this hidden part of the financial system, and regulators may not have enough time to react. Now, let's talk about something called the carry trade. Imagine borrowing money from a country where interest rates are really low, like Japan, and then using that money to invest in a country where interest rates are higher, like the US. You make money on the difference between the low borrowing cost and the higher return. This is called a carry trade, and it can be very profitable until something changes. In August 2024, we saw what's called a carry trade unwind. The Bank of Japan made a surprise move by making its monetary policy stricter, which meant borrowing in yen suddenly became more expensive. Investors who had borrowed in yen to invest in riskier assets had to quickly reverse their trades. The result? The Japanese stock market dropped by 12% in one day, and similar declines were seen in other global markets. Around $150 billion worth of carry trade positions were reversed within days, causing the yen to rise sharply against other currencies. Hedge funds were especially hit hard. They had borrowed money in yen and invested a lot in US stocks, and when the yen got stronger, they had to sell their US investments, which made prices fall. The VIX, which is often called the fear index of the stock market, jumped from 16 to over 65, which was the biggest one-day increase since 1987. The carry trade unwind showed how connected global financial markets are. A policy change in one country like Japan can immediately affect financial markets around the world. This is especially worrying because many investors use leverage, which means they borrow money to invest. This can make both profits and losses much bigger. When leverage is used, even small changes can lead to huge price movements, causing a cycle of forced selling and more instability. NBFIs played a big role in this situation. These institutions had borrowed yen to invest in things like US tech stocks and emerging market bonds, and they suddenly needed cash, which caused them to sell off their investments quickly. Their rapid sell off affected many types of investments, showing how weak and connected the global financial system is. A single event can trigger a chain reaction that impacts markets all over the world. Let's now talk about asset price valuations. Recently, global stock markets have gone up a lot because people expect the economy to recover smoothly. But even with good economic growth and earnings, stock prices still look quite high in many regions. This has made high asset prices a big risk for financial stability. Since the start of 2024, Canada, China, and the United States have seen some of the biggest stock market gains. However, this rise was briefly interrupted in early August when people worried about a possible economic slowdown, which led to a spike in the market fear. The Magnificent Seven, companies like Apple, Microsoft, Amazon, Google, Nvidia, Tesla, and Meta, continue to lead the US market, now making up to 30% weight of the S&P 500. While these companies have shown strong earnings, the overall market depends heavily on these few tech giants. While these companies have shown strong earnings, the overall market depends heavily on these few tech giants, which adds considerable risk. If any of these companies face significant problems, the whole market could become very unstable due to their outsized influence. The Magnificent Seven currently trade at elevated price to earnings, or the PE ratio. Nvidia and Tesla have a PE ratio of around 60, indicating high expectations for future growth. The S&P 500 is trading at a PE ratio above its historical average. The S&P 500's current PE ratio is approximately 26.28, which indicates that the market is priced with high expectations for earnings growth over the medium term. To bring valuation multiples back to normal levels by 2026, earnings for the S&P 500 and Nasdaq would need to grow by about 25% and 30% respectively, growth rates that are much higher than current economic forecasts suggest. If these optimistic expectations fall short, the market could force a sharp correction. This lower valuation suggests that while investors are willing to pay a premium for big US tech companies, they remain cautious about growth prospects in emerging markets. If asset prices fall sharply, it could create problems throughout the financial system because institutions with big investments could lose a lot of money. This could lead to even more selling, affecting both developed and emerging markets, since global financial markets are all connected. This kind of risk means that high asset prices in major markets could hurt investor confidence and economic activity all over the world. Finally, let's talk about how interconnected the financial system is. All the risks we discussed today, like government debt, commercial real estate, NBFIs, and carry trade, don't happen separately. In today's global economy, everything is linked. Think of the financial system like a spider's web. If you pull one string, the whole thing moves. A great example of this interconnectedness is the 2008 global financial crisis. It started in the US, where banks had heavily invested in mortgage backed securities. When people started defaulting on these loans, the value of mortgage backed securities plummeted. Large US banks suffered major losses, and the crisis quickly spread to financial institutions across the world. Banks in Europe also held these securities or had financial ties to US banks, which meant that the crisis was not just contained to the US. The result was a severe credit crunch, leading to a downturn in global economic activity. Similarly, if commercial real estate values in the US keep falling, smaller banks that have invested a lot in commercial real estate could face big losses. If these banks struggle, they might stop giving loans to small businesses and individuals, which in turn could hurt local communities. When banks give fewer loans, economic growth slows down, leading to more unemployment and less spending by people. This chain reaction shows how problems in one part of the financial system can spread to other areas. The carry trade unwind we talked about earlier is a good example of this connection. When investors suddenly pulled out of yen funded investments, it wasn't just Japan that was affected. The sell off spread to markets all over the world. Stocks, bonds, and even safe assets were affected. Because global markets are so connected, one policy change by the Bank of Japan led to a big increase in market instability around the world. NBFIs make things even more complicated. Hedge funds and private equity firms are closely linked to bigger financial system. When NBFIs need to sell assets quickly, like during the dash for cash in March 2020, they can cause huge disruptions in financial markets. The dash for cash episode was caused by a sudden rush by investors to sell assets for cash during COVID-19 pandemic. Investors sold everything from stocks to even supposedly safe assets like government bonds just to have cash on hand. This panic led to sharp price drop across markets, forcing central banks to step in and stabilize things. This event showed how quickly fear can spread through the financial system, especially when NBFIs like hedge funds rapidly sell off assets. These sell-offs push prices down, which can hurt other investors and create panic, leading to more falling prices and sell-offs. The key point from recent analysis is that while short-term financial risks seem manageable, medium-term risks are higher because of weaknesses building up in the financial system. Low borrowing costs in recent years have helped reduce immediate risks, but they have also encouraged too much risk-taking and borrowing, which can make things more risky in the medium term. The fact that market stability seems calm while there is still economic uncertainty means that sudden shocks could cause big problems and make financial system unstable. This means regulators and investors need to stay alert, especially as risks build up over time. The main point is that global financial system is extremely connected. Problems in one area can quickly spread to others. This is why regulators work so hard to maintain stability, not just to prevent one crisis, but to stop a chain reaction that could lead to a bigger economic downturn. And that's all I had to share for today's episode. I'll see you in the next one.